Live from the nation's capital this morning. Good morning to you all from Washington, D.C. Look at Wall Street now ahead of the market open with futures positive 0.5% on the S&P 500. On the NASDAQ 100, up 1/3%. That is your opening bow with equities just a little firmer. A euro with a 101 handle. Get used to that, apparently.
In the Dow up 200 points.
That is the first time that's ever happened in this hour on Bloomberg TV. I'm sure it's happened many times on Bloomberg Radio.
A number that America can understand, folks. The Dow Jones Industrial Average beneath the 36,000 level.
You're going to keep winding me up for the next 30 minutes. Let's talk about this bond market. 293. 293, Tom, on a US 10-year, and a bit of curve inversion out there too.
Very seriously, for global Wall Street, what we've seen here in the last 24 hours is further inversion, and I really want to emphasize to the pros, each basis point below flat zero parity really matters.
If I knew you'd be quoting that Dow, I would not have agreed to this, Tom. I would not have agreed to it. I imagine you're going to get about 20 more Dow quotes.
Can you get Anaconda Copper up there, please?
Okay, let's get to Katie Lights for more. Hey, Katie.
Hey, John. Well, we are actually seeing oil rebounding as well. $102 a barrel is where we trade on WTI, so no surprise. It is the energy sector that is outperforming at the open, and that's reflected in some of the individual movers like ExxonMobil, which is up more than 3% early in the trade here. You also have some of the more industrial metal-tied stocks moving higher as there's stimulus talk out of China. That's lifting the likes of Alcoa up about 7%. And then for some of those more idiosyncratic stories, Bed Bath & Beyond is one outsized mover higher this morning. Its interim CEO, other directors are buying up the stock after a 70% decline so far this year. That stock is up about 4%. And finally, GameStop. You know it, John and Tom. I know it. A stock split doesn't do anything for the fundamentals of a company, but yet the news of a 4-for-1 stock split coming from GameStop, the idea that maybe that makes it easier for retail traders to buy this stock, is lifting shares this morning up to the tune of nearly 7%, John.
Katie Lights, thank you.
Are they still memes? Are they still meme stocks?
Katie, thank you very much. I think people refer to them as meme stocks.
They're still meme stocks.
Sure.
Okay.
This is making it sound like we're really on top of this. You do realize that.
I know. On radio and television, what is so important here is to be fair and sometimes balanced. And we do this with John Farrow. I was so rude on July 4th. Thank you for the huge response from the United Kingdom. We did note that the colonies won the war back a few years ago, 1787. But to be fair, we also need to note on this wonderful visit to the Hay Adams and the history that we see behind us, that on August 24th, 1814, the British torched the White House. I just want you to be careful. They torched the White House.
Okay, let me share this with you. In my education, I don't know if it's true of British schools still, we weren't really taught about any of this.
I know.
At all. They didn't really tell us any of that stuff. So when it came to Independence Day and the celebration you have, we have no problem with it whatsoever. I'm very happy to wish my American friends a long weekend and a happy 4th. Well, why would you think that we would be offended by something that happened that long ago?
Because we believe in the Founding Fathers. Seriously, it's a huge part of our judicial debate right now. But we have an authenticity on Bloomberg surveillance because we know our history, both British and American.
This is an authentic, original program, that's for sure. Let me share this with you. I just had a sneak peek of CPI next week. Headline in the survey. Early days, hardly any estimates in, but on the headline number, do you want to know what that number is right now?
Double digit.
In our survey, 8.8%.
Wow.
Just another tick higher. Now, Wall Street, we know, will be trading off the month-on-month core figures. We get all of that. But that headline number, Tom, we're looking for an 8.8%. As things stand, and that can change as we build out the survey a bit more.
Folks, we're data dependent. That's what it comes down to.
Very much so for this Fed too. In Sun Valley, let's get over to Ed Ludlow for a little bit more. Ed, we're told the main event isn't today. It's not even tomorrow. It's over the weekend. Tee things up for us.
Yeah, so sources telling me that Elon Musk will arrive probably today, Thursday, and he's going to speak on Saturday, give a presentation of some kind. We don't know the content, but that's the slot that's normally reserved for one Warren Buffett. Warren Buffett always speaks on the final day of Allen & Co.'s conference here in Sun Valley. Interesting, you're talking about inflation. Inflation's really top of mind here, but so is the spending power of the global consumer. And I was watching Samsung overnight, right? 21% jump in quarterly sales for the June quarter. They are the bellwether of consumer spending because of electronics, and that better than expected sales helped by the Korean won. You see the Nasdaq 100 up higher, chip stocks driving that during Thursday morning session. Everyone's paying attention to stuff like that here, John. They're looking at their industries. These are TMT executives. They want to look at signs in the semiconductor industry where we've gone from a deficit of available chips to a glut, and things are looking more positive in the moment.
Ed, what does the famed Ludlow humility meter say in Sun Valley? If we've had the challenges of Netflix, the challenges of Amazon really, really struggling and moving cardboard boxes, what's the humility level you're acclaimed to measure?
Everyone is high-fiving, Tom. They're out on their mountain bikes. What I'm told by return attendees of the Allen & Co conference is this is like it was pre-pandemic. They're paying attention to the short-term volatility in public markets, but they're positive. You know, David Zaslav, Warner Discovery CEO, is kind of king of the hill because his company went through a successful merger. He's optimistic about how they're faring, even with a sort of cost-cut reduction program going on in the background. And then the titans of last year, you'll remember, Tom, you and I spoke last year, and you reminded the audience of what a fantastic skier I am with the mountains behind me. But Reed Hastings, Ted Sandros at Netflix, they were the kings of the hill last year, and they're having a much lower profile visit this year. But all the same things are happening, the same meetings in the corridors, the same talk of the global economy, but with optimism.
There we go, Ed Ludlow. That must be the one place on the planet, where they're running around high-fiving each other.
Could you see me and you going to Sun Valley?
No.
First of all, we'd have to wear ties.
I thought they wear those vests.
Well, I'm not going to wear some stupid Patagonia vest. You know, I look like a beach whale. But the bottom line is, John, the bottom line is Ed absolutely nailed how they are so removed from reality.
How do you expect me to speak after picturing you in a Patagonia vest like a beach whale?
How many people, seriously folks, Zaslav at Discoveries, there's some amazing challenges there.
Sure.
Warner Discovery merging and all that. They're going through serious cost cutting and they're out there wanting beach.
Can you go to our next guest?
Okay, well, I'll go to Brian Weinstein right now, who's going, do I have to talk about Sun Valley? No, hopefully I don't.
No, please don't.
Brian, good morning to you, and thank you for joining us. We're a little punchy here. It's been a hugely political day for us. When we look at the markets right now, they're going to come off a jobs report. It is a jobs report. It's not historic, but it has a certain weight to it. How do you trade off this jobs report? How do you reallocate off this jobs report?
You know, I think the market is still coming to terms with the Fed and the slowdown and, you know, the idea that we're just going to easily hike and then ease. The bond market has a lot of adjusting to do. So I think this report will give us a slight window into what's coming, but it's not going to settle anything. I think the markets are going to be just as unsettled after the number tomorrow as they are today.
Just reading another downgrade, Tom, from the S&P. John Stolfus of Oppenheimer. Did you see that one coming? I think many of us were waiting for it. 4,800 is his new price target. The previous read from him, the previous target, 5,330. Of course, as we know, we had Jonathan Goldberg, Credit Suisse, come down from 4,900 to 43. So still pretty bullish, John Stolfus, looking for 4,800 year end. Brian, I've been catching up with people in the bond market, and as you know, one of the questions we've been asking is whether we've seen the high in the 10-year yet for this year. Now, I think a lot of people in this equity market would take comfort from that. If you think we have, do you think we have?
I'm not sure we have. I think we may have come close. I think we have to revisit it. I think we got that nice bounce off of that 350-ish level, and stocks felt better about, again, the ease that's coming. I read the Fed minutes yesterday and look at the data, and I don't think it's going to be that easy. I think inflation is not going to slow down as quickly as they wanted to. Growth is certainly slowing, but I don't think it's a disaster. So technical recession maybe, but is the Fed going to stop? No, and I'm not sure we've seen the highs yet.
Brian, there's a partition seriously at Sun Valley between companies minting money down the income statement and a lot of others, maybe with some good revenue pop, but that's about it. In the recovery out 1 year, 2 years, when Mike Wilson tells us that it's finally stocks up, will there be a partition between free cash flow and those that don't have it?
I think so. I mean, the way we look at it in the bond market's a little bit different, but certainly I think that the idea that we're going to get free money again, the idea that you can buy any bond and it's not going to default, I think that's going away.
Yeah.
Which is why I think you're seeing junk bonds struggle, which is why you're seeing loans struggle a bit. There's great value out there, but there's also great danger, right? So the idea that you can just buy any bond and that you're going to be okay, to answer your question directly, I think cash flow is going to matter, and it matter a lot.
Well, I wanted to bring this up, Brian, because it's so important to the bond market. Is the surprise going to be the issuance of more debt by the haves, by the companies with huge free cash flow?
I think they'll continue to issue. I'm not sure it'll be a big surprise. I think people are going to be surprised at how much the curve inverts, and that means that's okay. I mean, it's not great, as you say. It means recession, but as far as being an issuer, you can issue out the yield curve, right? These are still historically low rates. Companies are still growing faster than the rate they're going to issue at. So I expect that we'll continue to see issuance out the yield curve from those companies for sure.
Brian, if you don't think we've seen the highs on 10-year Treasury yields, do you think we've seen the wides on credit spreads?
No, I don't think we've seen the wides on credit spreads. Again, in a default-adjusted environment, at 4% high yield, a couple of months ago, and everybody wanted it, people were expecting a 1% default rate, and yields in places were negative. With yields positive and yields positive across the globe, and default rates going up, I think you're going to see wider spreads still. So I don't think we're done yet. Again, with the Fed hiking rates more and the uncertainty out there, I think we've seen probably the worst of it, but I expect spreads to keep leaking wider.
Brian Weinstein at Morgan Stanley. Wow, those two takes from Brian Weinstein just there. Tom, if you're an equity bull, can you take any comfort from one, Brian Weinstein saying, I don't think we've seen the highs on 10-year Treasury yields, and two, essentially off the back of that, suggesting he doesn't think we've seen the wides on credit spreads either. If you're long equities and that call materializes, we got a problem, haven't we?
I must say we need to see the credit spreads level or come in, I should say, if we really want to get more of a bullish tone. We're not there yet. The last couple of weeks have been really ugly.
It's been tough,
we're weak at this without Abramowitz here, but
We'll be better with Lisa next week
yes,
when she
will.
comes back. But on the credit front, as you know, and we talked about it with Lisa last week, we've taken out levels that we took out back in 2018 that forced this Federal Reserve to rethink its tightening. This time around, because of the inflation backdrop, that so-called Fed put is in a different place. Some people might say it's retired and it will take a lot for this Fed put to come out of retirement.
I believe in the power of the institution. I would suggest the put can still be there. I talked to Lisa last night, John, about CDS and Crete, and she said there's enough momentum there. There's enough dynamics, if you will, there right now that off the jobs report and on a bullish recovery framework, you need to have her world improve.
You brought up CDS and Crete, and I know you're joking, but thinking of Greece and perhaps going across to Italy and over to Switzerland too. Have you seen the CDS on some single names, on some European bank names at the moment?
The bank names are frightening.
Tom, we got a problem in that economy.
Yeah, this is frightening, and we like to be polite here, and when we speak to people from continental Europe, maybe we don't mention individual banks. It's maybe a bit rude, but for Global Wall Street, the CDS value on the Bloomberg terminal right now is front and center, absolutely.
Without a doubt. Front and center for us is the White House, and coming up, the Biden administration facing surging prices and a slowing economy.
The president is not shockingly naive, and we are in this moment of global crisis in terms of energy, and he is using the tools at his disposal to make sure that the prices that people pay at the pump are fair.
We'll get the view from the White House with the National Economic Director, Brian Deese. That conversation is coming up next from Washington, D.C. This is Bloomberg. Live from the nation's capital this morning, a good morning. Together with Tom Keene, I'm Jonathan Ferro. With equities up, let's call it 39 points, up 1 full percentage point, TK. I make that day four. Day four of grinding out some gains, TK.
I think it's about
going into a big print tomorrow morning.
Tea leaves, inflation rolling over a little bit. Certain indicators of things are better. It's 1600 Pennsylvania Avenue. I believe a gallon of gas is not as painful as it was 10 days ago.
We're moving things gradually in the right direction.
Gradually.
I don't think anyone in that building behind us wants to declare victory just yet, that's for sure.
Well, there we are, and of course on a trip to Washington and with the drama that we've seen in the United Kingdom today, we need to drive forward the conversation on the nation. We do so with Brian Deese. He's National Economic Council Director, of course working for years with Gene Sperling. And what is most important here, and part of the act of Bloomberg surveillance and what we did with Bloomberg on the economy, is microeconomics matters. There's too many people out there blathering the big picture without the foundations under it. Mr. Deese knows from Middlebury 155 in economics, microeconomics matters. I would suggest the price theory is going in your direction. There's little indications that maybe the pain is over. Not all clear, but can you say there's some constructive elements out there that you see?
Well, look, to start out, prices are unacceptably high. We are also seeing some moderation, and that moderation is important. You've seen it in core PCE, the metric that the Fed traditionally relies on, moderation over the last 3 months, particularly compared to the prior. And as you mentioned, we're seeing for the typical American consumer, a little bit of relief at the gas pump. Prices down to about $4.75, down from, down more than 25 cents. But let's be clear, they're still unacceptably high. We've got a long way to go, and so we got to keep our head down and keep a focus on bringing prices down while not giving up all the economic gains that we've made.
One of our wonderful guests, Jim Bianco of Chicago, wore a whip inflation now button on the show the other day. You people have avoided the idiocy of the early 1970s. But with that, the president has to provide a morale boost to people hammered by inflation. How do you do that?
It's not just a morale boost. We have to act, and we have to show action on behalf of the American people, and that's exactly what the president is doing. He's saying bringing prices down is his top priority, and every day he's focused on practical things that he can do. So the release of oil from the Strategic Petroleum Reserve sounds esoteric to people, but oil market analysts you've had on this show will say it was single-handedly responsible for keeping oil prices going higher. Moving to work with the refineries to try to keep refinery capacity online, that is important and makes a difference. And as we're seeing, we're starting to see a little bit of that moderation at the pump. The president is saying, let's do more. Let's do everything we possibly can. He called for a temporary holiday for the gas tax. That's not going to solve every issue. That would make a little bit of difference as well. So you need a president who's going to keep at it and who's going to communicate clear to the American people that we are making progress, that we have made enormous economic progress, but that he's not satisfied and we're going to stay at it.
You're not satisfied either, but you've talked about a higher goal. You've talked about defending the world liberal order and that we had to stand firm. What did you mean by that?
Well, let's be very clear. That's a concept that Republicans and Democrats have embraced for years, and it's about democracy. It's about the democracy and the democratic tradition that grew out of World War II and that has served our national security interests and economic interests well. And standing up for democracy is something that this president feels strongly about. And so we are going to fight to bring prices down. We're going to fight to get increased oil supply on the market. But what we're not going to do is to suggest that the only way to do that is to actually step away from the Ukrainian people, to step away from fighting for democracy and everything that believes.
If standing up for democracy is truly paramount, and you've quite clearly just suggested it is, why is this administration considering removing tariffs on the Chinese Communist Party, which is anything but a democracy, and is also a government that you've accused of genocide? Why is that a consideration? And how does that reconcile with this view that this is about standing up for democracy?
Our economic policy should be about promoting economic security for American workers, American businesses, American families. And so we have to look at everything through that lens. In the prior administration, they took an approach to escalating trade tensions and a trade war with China that ultimately didn't serve that purpose, didn't help our farmers and our ranchers, didn't help many sectors of the economy. So President Biden came into office committed to the proposition that we need to get tough on China. There are places where we need to be tougher and clearer about their non-market practices, about their human rights abuses, but we also need to be smarter about how to do this as well.
Why is that smarter? And let's go back to the question again and lay things out clearly. You've accused the Chinese Communist Party of genocide. You're saying that what is paramount here is defending democracy, and that defending the liberal world order is more important than the pain that people feel at the pump. And ultimately, this administration is considering removing tariffs. I wasn't convinced by the last answer. I don't think many others will either. This is an awkward moment, I know, but I really need to understand from you why it makes sense for this administration to consider removing tariffs on a country that you're accusing of genocide.
First of all, I want to you mischaracterized my position, so I want to clarify.
Please do.
Bringing prices down for the American people is the president's top priority. He's focused on it every day, and it's because he understands the pain that people are feeling at the gas pump and around the kitchen table. At the same time, he does not believe that the way to do that would be to step back from our democratic values or to step back from protecting the Ukrainians against the invasion from Vladimir Putin. He does not believe that that is an acceptable or an appropriate choice. So, given that, our focus is on how can we actually advance the ball, and you're seeing the president in action right now doing that. The actions that he's taken around oil supply, the actions that he has taken around refineries, the actions that he is calling for around tax reductions, they all would make a difference, and they make a difference for American families.
Let's sit on China just for one final question and try and focus on policy, and I appreciate your follow-up answer. Let's talk about what you can do, because what we understand is that you're looking to remove some tariffs on certain goods, but perhaps double down the effort elsewhere. Can you give me a deeper understanding of where the current thinking of this White House is and the direction of travel for policy?
Well, there's no question that if you look at what the Chinese economy and the non-market practices that the Chinese leadership are undertaking, that there are sectors of the economy where they are engaged in unacceptable activities, and that those present a strategic risk to our economy and our national security. And so those are the places where we need to focus on using all of the tools at our disposal. Tariffs are one tool, but we have other tools as well to make sure that we are protecting key sectors of the American economy and that we are holding to account for those. You look at something like semiconductors, which we've talked about before, and which is incredibly salient. We, of course, need to act here in the United States to invest in building our own domestic resilience, but we also have to take seriously that some of the actions that China are taking expose us more deeply, and we need to counter those.
Brian Deese, wonderful to catch up, the director of the National Economic Council. Tom, these are really complex issues that we have to work through right now.
They are a new regime. That's all there is to it. And just to look at the Philippine election and how we project to the Pacific is part of that Chinese calculus.
Looking ahead to payrolls Friday, and perhaps another big CPI print.
Are we
next
back
week
in New
too.
York or are we here?
I understand we head to the airport straight
We
after
do?
this, and we fly to New York.
Okay. Oh,
With Tom
Teterboro, I
Keene.
think I can get into Teterboro.
You flying private?
Yeah.
I'm not. That tells you something about the difference between the two of us. Tom Keene, Jonathan Ferro, live from Washington, D.C. Thank you to all of you on TV and radio. This is Bloomberg Surveillance.
from the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Thursday, July 7th. Here are the top market stories we're following for you at this hour. Boris Johnson resigns. The UK Prime Minister gives up his fight to stay in office after a wave of resignations, with a timetable for the leadership election likely to be announced next week. And pricing unknowns. Volatility grasps financial markets from bonds to FX to commodities as the calls for inflation and recession range wide. And looking ahead to Jobs Day. Initial jobless claims coming in on par with expectations, but it's the payrolls number tomorrow that could signal cracks in an extremely tight U.S. labor market. From New York, I'm Kriti Gupta with Guy Johnson, who is by Westminster in London right now. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, a historic moment, a UK government really trying to figure out how to move forward.
Absolutely. Boris Johnson has departed, except that he hasn't. He is going to remain as a caretaker Prime Minister. Nobody's quite clear what that exactly means, but in theory, we should now start the process of selecting a new Prime Minister. That Prime Minister will be selected, Kriti, from within the Conservative Party. They have the majority in the House of Commons behind me. They are in power, so they get to select who will be the next Prime Minister. So that process will unfold. Could take a little while, though. So what we need to figure out now is exactly who that person is going to be. How Boris Johnson's exit will ultimately work, i.e. how does being a Conservative Prime Minister, being a caretaker Prime Minister actually work? And then we need to figure out what the fiscal landscape is going to look like next. We've got some great guests lined up over the next few hours right here in Westminster. We've got the Conservative MP, Tobias Ellwood. He's going to be joining us. He is the formerly from the Defence Ministry. He's going to be joining us. We'll talk about the FX channel with Jordan Rochester of Nomura. Simon Fraser, former Foreign and Commonwealth official, is going to be joining us a little bit later on to talk about the politics of what is happening here as well. So some great guests lined up to try and understand exactly what is happening here. Boris Johnson has gone, but he hasn't. The process of selecting a new Prime Minister starts. What will be the main criteria for that selection process? Well, we need certainly to discuss that, Kriti.
And Guy, of course, we're going to talk about the market reaction as well as we have those developments come. We're looking at 120 on the cable rate. We're going to keep you posted on what that actually means and what the implications are for the broader asset class. Let's get to today's question of the day. Which asset class has it right? You're seeing bond volatility, FX volatility, commodity volatility, perhaps a little bit light volume in the stock market. We're going to bring in Bloomberg's international economics and policy correspondent Michael McKee and macro strategist Vincent Signorella. Vince, I want to start with you here because to me, it's the FX story and the bond story that's really taking the limelight right now. These kind of extreme volatility you're seeing both in the bond market and in, say, the cable rate, for example, coming off of some of the politics here. Which market has it right?
Well, I mean, on a short-term basis, both the dollar and the fixed income markets, the bond markets, have it as they're following the Fed going forward. My suspicion, however, is they're not going to be right for very long. My take on the Fed, and I'm sure Mike will disagree, is that after July, I think they're going to find themselves in a situation where the economy is rolling over and the extent of aggressive Fed hikes that are priced in are a little too aggressive. So in reality, if you look at the asset classes and where things have gone, in a strange way, the equity market seems to have it right with the massive sell-off due to higher inflation, higher oil, and the crisis in Ukraine. But if I borrow a line from Mr. Tom Green, that's like saying you're the best restaurant in the hospital.
Mike, let's pick up there and talk about kind of the various asset classes and what is happening with the economy. It strikes me that actually asset markets aren't particularly a good gauge on what is happening. What we're seeing here, and I'd be interested to get your take on what is happening with the liquidity situation, is the Fed withdrawing liquidity. We're starting to see the effects of that. The bond market, particularly the front end, is all over the place. Copper is all over the place. Commodities are all over the place more broadly. The equity market actually feels like an area of relative calm right now. But what we're seeing here is not only the economic situation changing very quickly, but the liquidity situation changing very quickly as well. What impact is that having? Well, it's hard to say exactly because the liquidity that the markets were using was artificial anyway, brought about by the Fed. That doesn't mean that there isn't going to be a liquidity issue or that there is that affects markets going forward because the Fed at this point is still has a very large stock, put it that way, of bonds on its balance sheet. So the liquidity is sort of still there. The question is, what are markets doing? And kind of the answer is nobody knows at this point because nobody knows what's going to happen. You asked what the best market would be, and I was going to say the options market because you look at the MOVE index and the VIX not as much, but also the Forex volatility measures, and you see all kinds of movement because everybody's trying to guess what the Fed is going to do, and with the economic data coming in mixed, they don't have a good picture.
Well, Mike, let's stick with that story here because we actually are getting a headline. The U.S. mortgage rates plunging to 5.3%, the biggest drop since 2008. At the same time, we're looking ahead to payrolls tomorrow. And I'm curious, is there some sort of beacon that we're looking at for perhaps that major red flag, that major kind of canary in the coal mine, if you will, when it comes to the U.S. economy and what perhaps financial markets should actually be looking at here?
Well, it's kind of hard because most of the data are delayed. You're looking backwards at what happened. And that's one of the mistakes I think people made with the Fed minutes. That Fed minutes were 3 weeks ago based on data from April and May. And so the Fed has to watch the incoming data as well. Probably jobs is going to be one canary in the coal mine. As long as the unemployment rate stays below 4.5 or so, you're in the range of what the Fed thinks is full employment, and they're not going to panic. But we're also going to need to see what happens with CPI and PCE, the inflation measures, because those are going to tell us something. One of the interesting things is how the markets have reacted to all this data. There doesn't seem to be a middle ground. It's either recession or overheating, and yet we're seeing things like the mortgage situation suggest that the Fed's impact is starting to be felt, and this is what is supposed to happen.
Vince, let me just come back to you. The markets clearly don't know what the picture is going to be going forward. You're looking at a 2-year that, as I say, is being whipped around incredibly. Commodity prices that are being whipped around incredibly. We've been through a 10-year period where effectively QE has anesthetized the markets as a signaling mechanism. That has been by design. The central banks have put these markets to sleep. They're starting to wake up again. The question is, do we have the skill set and the muscle memory to actually turn these markets back into a useful predictive tool as to actually the way that the economy is going to develop and the global economy is going to develop from here?
I think that's going to be very much up to the central banks, and I think the central banks have to stop trying to dictate policy and listen to what the markets are actually doing. Mike brings up two good data sets to look for, CPI and PPI. One that I would be looking at very carefully next week is consumer sentiment. If you go back to 2008, sentiment and Fed interest rates were running together. That correlation broke in 2011 when the Fed stayed easy for an additional 5 years as sentiment was improving. And you could argue that's the argument where people say they stayed too low for too long. And then in 2016, they started to raise rates, started to come to where consumer sentiment is. But now they're on this still aggressive policy as sentiment is plunging. And once again, I get the feeling the Fed's trying to dictate to markets and consumers where interest rates should be. They're not feeling where the consumer is telling them that they've already felt the pinch from the moves that the Fed has made so far. And consumers are coming back down to where the Fed wants them to be inevitably. And I feel like the central banks are trying to get there in such a hurry, they're going to run over this economy and push us into a recession. So until we clear that hurdle and we're back to some sort of balance between supply and demand, I think the markets are going to stay confused.
And it's that confusion I think is so really key when we bring it back to our question of the day. Bloomberg's Michael McKee and Vince Signorello, we thank you both as always. Coming up, we're going to ask that exact question. Which asset class has it right in the state of confusion with Catherine Rooney-Vera of Boltic? That conversation next. This is Bloomberg.
This week, June jobs are in focus.
I think we're all very curious how June jobs came in.
The labor market is tremendously strong.
We have never been in a recession with declining unemployment.
This Friday, the surveillance team will bring you crucial data and expert analysis at terminal speed.
There's so much uncertainty. We're going to have to monitor the data closely.
Everyone needs to recalibrate at 8:31 a.m. this Friday.
The June Jobs Report, Friday on Bloomberg Television and Radio.
Turning back now to our question of the day, which asset class has the right from bonds to FX to stocks? We're going to ask Catherine Rooney Vera, our Baltic Capital Markets Chief Investment Strategist. Catherine, thank you as always for joining us. We were just talking to our very own Mike McKee and Vince Signorella about the state of confusion. It kind of seems like these markets are in some pretty wide ranges when it comes to inflation calls, recession calls. To you, which asset class is pricing all of this correctly?
Yeah, thank you. I think at Baltic, the important thing that we've been looking at is what has taken us to this dislocations in the market where we have to ask this question. And the answer to that is the Federal Reserve stimulus and the federal government stimulus. So until that goes away or seems like it's no longer going to be a player, the most major player in the markets, then I think it's going to be a difficult question to answer. I refer, of course, to quantitative tightening, which the risk then is once we move into recession, that goes back to easing, manipulating further the fixed income markets and bringing on that risk appetite into the equity market. So I think that's what a lot of people are talking about or thinking about right now. Quantitative tightening, how long will that last? Will the Fed be able to both hike rates and roll off its balance sheet to the tune of almost $1 trillion? And at the same time avoid recession. So I think that I think it's going to be very hard to really answer that question at this time period.
Catherine, you bring up the issue of recession. Where do you think we are in the economic cycle right now? I look at the ISM data yesterday from services, mid-50s. That doesn't even feel like late cycle. That feels like mid-cycle in terms of the kind of numbers we're seeing there. Suddenly doesn't feel recessionary. Yet if I look at what has been happening in the bond market over the last couple of days, the pricing of recession has increased significantly. How do we get a handle on where we are in the cycle right now? The Fed certainly is signaling that at the moment it feels like it's got a long way to go in terms of its tightening.
Well, the economic cycle has peaks and troughs, and I think unequivocally, Guy, we have already seen the peaks. So we are in deceleration. I think we're de facto in stagflation, something that with the Fed's recent adjustment of its economic forecast has acknowledged, because we have growth below potential. They're expecting 1.7 versus potential of 2.4, 2.5. With inflation, they even expect above 5% for this year. So that's stagflation. The next point in the economic cycle is recession. Pointing to the trough of the next economic contraction is impossible to say with precision. But what I can say is that, and I think we've been talking about this a lot on Bloomberg, is that the labor market, it's really hard to have a recession or say we're in recession when we have 3.6% unemployment rate, and you still have a consumer that's still spending on recreation and travel and hotels. And that's de facto what we're seeing. So my laser focus is on non-farm payrolls tomorrow, unemployment rate, labor participation rate, when we see a rollover in the labor market, and my estimation is that magic kind of number is 4.2%. So I think once we get to that 4.2% or even higher in terms of unemployment, we're going to be in recession, and that's what I'm looking at in terms of what could be the nail in the coffin for the consumer. I'll add one more thing. Inflation is not going anywhere, and I think the Fed knows that demand destruction is the only thing that will really bring inflation back to the 2% target. Gas prices can come lower, which they're unlikely to do so. We could have improvements in the supply chain. That'll help inflation. So will base effects, because inflation was really high last year. So by the end of this year, we do expect inflation to come down. But to get to the 2% target, my suspicion is that we need to have economic contraction. I think we are moving towards that as the next point in the economic cycle. And I'll go back to the other question that was asked. What asset classes got it right? How does the Fed respond to that? They can't take rates up too high and then bring them back down. My suspicion is that we go back to the old playbook or the new playbook, which is quantitative tightening moving back into easing.
Well, speaking of that quantitative tightening, Chairman Powell has been very vocal about having the market perhaps do some of its work forward. If you look at financial conditions, for example, they've been in restrictive territory or very tight conditions, I want to say for a couple of months now. How much further can you see that tighten for this to actually be a successful way for the markets to function?
That's an excellent point, and perhaps the Fed doesn't even have to go as far as it's expected to do so at the 3.5% terminal rate and the big roll-offs of its balance sheet if the market does some of its work for it. You're right on that. Financial conditions are tightening, and that has a lag effect. So when you hear analysts come out and saying consumers doing fantastic, it's resilient, it's going to help us avoid recession, or it's going to make the recession very smooth or moderate in its magnitude, I would say wait a few months on that, because you have the combination of, here in the U.S., our net worth, the bulk of it is attached to our housing value and our 401ks. Both of which, one is getting hit more than the other, but the housing market doesn't look too strong either in the future. So I think that the months ahead we're going to see both a rollover in the labor market, which is going to bring the consumer contract the consumer spending even more, and that's going to probably allow the Fed to not hike or roll off as aggressively as it has intended to do so.
Catherine, looks like we're in for a volatile time. We're certainly seeing that in British politics. We're going to talk about that next. Catherine Rooney-Vera of Baltic Capital Markets, thank you very much indeed. Still ahead, as I say, we're going to get back to what is happening here in Britain. Boris Johnson is holding a cabinet meeting right now, yet he is no longer officially the Prime Minister, a caretaker Prime Minister. We're going to speak to an MP critical of his leadership, Tobias Ellwood, joining us from the Conservative Party next. This is Bloomberg.
About that all day yesterday.
So, Boris Johnson has bowed to the inevitable and is resigning as Prime Minister. This after 3 years. He spoke at 10 Downing Street a little earlier.
It is clearly now the will of the Parliamentary Conservative Party that there should be a new leader of that party and therefore a new Prime Minister. And I've agreed with Sir Graham Brady, the chairman of our backbench MPs, that the process of choosing that new leader should begin now. And the timetable will be announced next week. And I've today appointed a cabinet to serve, as I will, until a new leader is in place.
Great stuff.
Joining us now here in Westminster, Tobias Ellwood, Conservative MP, former Defence Minister. Good afternoon.
Good afternoon.
Are you comfortable with Boris Johnson remaining on as a caretaker?
That's a big question now. It's taken some effort to get to this point. Today I was looking at my emails, and it was on the 2nd of February that I put in my first letter to Graham Brady to say that I had no confidence in the Prime Minister, and I felt a bit lonely at that point. Looking back at that, now we are where we are, and we do need a process to get us through to provide the necessary leadership context to select a new leader. Now, if that is going to take too long, then yes, I think there will be many colleagues that will say we're uncomfortable with Boris Johnson remaining in power or controlling all the levers of power anyway.
So how long do you think the process will take? How long will it take so that we can avoid that situation?
Well, it's a two-phase process, as you're probably aware. The first phase is the MPs, ourselves, select two candidates. Those two candidates are then put to the party base, who then make that selection. I think we can get through that first phase in a matter of days, in a week and a half, 2 weeks or so. And then you've got about a month or so where you've got to go to the country, allow the party membership to then make a judgment on it, comparing those two, having a vote towards the end of that. And that'll probably be concluded, I suggest, by first week in September.
But if Boris Johnson decides to enact policy during that period, what happens?
Yes, I mean, that is the big question. He's lost the support of the backbenchers. He's lost the support of his cabinet, many of his ministers as well, and that's why people are troubled as to how much power he can yield during this period, and whether or not there can be an interim Prime Minister, the Deputy Prime Minister, for example, stepping up. But that would require going to the Queen, and we'd be wandering into very, very new waters here. We've never been in this territory.
This is Bloomberg, so let's talk a little bit about kind of financial and economic policy. This is the Conservative Party. The Conservative Party historically has been the party that cuts taxes, not raises them. Do you think there is the capacity currently to cut taxes?
Well, what's interesting in this leadership contest is that everybody will putting up their stalls and making it very, very clear what they want to do. And the financial services will be very critical of that. It's one of the strengths of Britain. And I think you may see a little bit of competition between the actual candidates themselves in trying to offer a low-tax economy, plans to actually take Britain forward. We're missing that vision at the moment. With Boris Johnson, he was spending every day firefighting, so we never had an opportunity to see where the country was going to go. In fact, we got mixed messages, with some taxes going up, some taxes going down.
But do you think that this is a party that is heading in a more fiscally conservative direction? Boris Johnson has been more freewheeling in terms of the economics of the UK than many of his predecessors. Do you think that we're in a position here in the UK where taxes could be cut? Do you think that is necessary? Or do you think actually, given the fiscal position that we currently are in, that it is something that is simply not possible?
Yeah, I mean, the real reason why Boris is now being removed is because of the culture, the lack of discipline and focus, but it was also because we were drifting away from what the party actually stands for. And you've just articulated it. We are a low-tax economy. That's what Britain does under Conservative government, and we've not been doing that. So, as I say, that's what we'll now see in the election manifestos of the leadership candidates, and that'll be very interesting to see where we go from there.
I've just been handed a few minutes ago the latest betting odds in terms of who potentially could be succeeding Boris Johnson. Mr. Wallace appears to be at the top of the list in terms of the narrowness of the odds. How do you see this progressing? Who do you see as favourites? Who do you see as being in the running? Who would you like to see in the job?
One of the things, looking back in February when I did put in that letter, was the arguments by Boris Johnson's team was that there was nobody there that could step forward and fill that vacuum that lead the country. And I'm pleased to say that we actually have a number of candidates, not just Ben Wallace himself, who would be very, very competent, but a number of candidates that I think we could live with and do a better job than we're currently seeing at the moment. Ben's had, I think, a great outing with what he's done in Afghanistan and indeed the war as well, but there's others. There's Nadhim Zahawi, for example. There's Jeremy Hunt. There's Penny Mordaunt. We have a number of people that we now need to learn more about as to where they would take the country. What I do hope is that we avoid the party splintering. I'm afraid the Brexit issue remains high. It's a difficult issue, as I found out to my costs when I suggested that we're not economically benefiting as we should do from the current model. No ambitions to take us back into the EU whatsoever. I think we politically removed ourselves from that. But economically, both Remainers and Brexiteers appreciate that this model does need to be addressed. So I'm afraid it is a Brexiteers market when it comes to the leadership contest. It's likely to be somebody simply because of our base. Our base is quite right of centre, and that, I'm afraid, is the lay of the land.
Tobias Ellwood, thank you very much indeed. Greatly appreciate your input. Tobias Ellwood, UK Conservative MP, former Defence Minister. We'll see how this whole process unfolds. Coming up, oil prices making a move higher today after being sharply lower over the last few days. We'll get an analysis on where this market is going. Francisco Blanch, Bank of America, joining us next. This is Bloomberg.